Hi guys, welcome to another Alpha and Edge webinar series with Bay Equity. This time I get the pleasure of doing a presentation. This is one of my favorite loans we're going to talk about today called the All-in-One Loan. Do a little housekeeping here. Marion, who's my marketing buddy, is in the background. She's going to monitor the chat. So those of you on the webinar, if you want to ask any questions at all, just put those in the chat. Marion will probably keep those to the end, and if not, if it's really relevant for the particular slide that I'm on, she will interrupt me and ask the question at that time, which is just fine. That'll work good. And so let's get started here. I'm going to share my screen with you all, and we're going to talk about one of my favorite loan products called the All-in-One Loan. So understand that, once again, that I manage a branch for a company called Bay Equity Home Loans. The all-in-one loan is not a Bay Equity product. It is a loan that we broker to a lender that is exclusive to the all-in-one loan, to my knowledge. It's called a sweeper loan, if you've ever heard that before. And there probably are other banks that do this loan. I'm just not aware of any. We have a very tight relationship with this particular lender. We use them a lot for the all-in-one loan. The all-in-one loan is a first position home equity line of credit. That's the first thing you want to understand. It's not a 30-year fixed loan, but it is a 30-year loan, and you can draw on this line of credit for up to 30 years. I'm going to show you a slide which shows you how that gets modified over time. That's very different from a regular HELOC, home equity line of credit, which typically has a 10-year draw period, as you know, if you have those. And it then goes into an amortized loan for whatever balance is remaining to get paid off. All-in-one loan, you have potentially up to 30 years for the draw period on it. It is a variable rate. All home equity lines of credit, to my knowledge, are variable. This particular one is tied to an index. We're going to talk about that in a little bit here. You have a margin. You add your index and you add your margin together, and that's what establishes the rate on your HELOC. And that's true of all HELOCs, to my knowledge, including the all-in-one loan. We'll chat about that a little bit deeper as we go along here. There's the index right there. The index on this loan is the one-year Treasury bill. So those of you who are very familiar with mortgages understand that long-term adjustable rate mortgages typically have been tied to an index called LIBOR, which is the London Interbank Offered Rate. But the mortgage industry is getting rid of LIBOR for various reasons. And the lender that has the all-in-one loan had looked around and chose the one-year Treasury rate, which is also called the CMT. That stands for the Constant Maturity Treasury Bill. What that is the 12-month average of the 1-month Treasury. So you take every month, it happens that the oldest month drops off the average and a new month pops on the average, and they average it out again, and that is your index. And adjustable rate mortgages have an index. Those of you who have regular HELOCs are pretty used to prime, the prime rate, which also can change every month, just like the CMT, the Treasury rate, can do in this particular case. So your loan is going to be tied to that. You're going to get another number called the margin. The margin is a fixed number that you choose at the beginning of an adjustable rate mortgage, just like the all-in-one loan. You pay more to get a lower margin. You pay less to get a higher margin. That margin, whatever that number is added to the index, whatever that number is, and that establishes the rate on your line of credit. So on a monthly basis, the rate can change on the all-in-one loan, just like other lines of credit. You want to be very well aware of that. This particular loan requires full documentation of income. It's underwritten to what we call Fannie Mae guidelines, which means we get tax returns, we get pay stubs, we get W-2s, we get all of that information to underwrite the loan. You have to be well qualified to get the all-in-one loan. We have lots of other loans where we use various ways of calculating income, like the DSCR loan, if you're familiar with that, or like bank statements for a self-employed borrower. That is not the all-in-one loan. All-in-one loan, if you're self-employed, we're going to get 2 years of tax returns. If you are employed, we're going to get your W-2 and your pay stubs. We want you to be employed for at least a year and probably 2 years or longer. If you have Social Security income, you have pension income, we will use that. And we also use assets for income, which I'm going to show you in a little bit here. That's one of the advantages the all-in-one loan has over typical 30-year fixed loans that Fannie Mae has. You can do the all-in-one loan on owner-occupied and non-owner occupied properties and second homes. So all three of those will work. I think I'm going to tell you someplace in here, you're limited to 2 all-in-one loans maximum, and only 1 can be a non-owner occupied. That's the current guidelines on that. And before I go any further, understand we're going to talk about guidelines later. Guidelines change frequently on loan products, and that is true of the all-in-one loan as well. So you want to make sure you talk to your mortgage professional and understand what the guidelines are for that particular period of time and get a really full understanding of the loan, all loans, when you move forward, just like the all-in-one loan. But you can do it on an owner-occupied, one of those, and then you could have one on a second home and as well as one on your owner-occupied home if you chose to do so. So what makes this loan so unique, what makes it work so well, I'm going to show you this in a graphic format in just a few minutes here, is that the loan is tied directly to an online bank account. This is not the bank account you have currently, almost certainly, whether you're banking with one of the big banks or your local credit union or whatever it is, it's not going to be that bank account. So if you do the all-in-one loan, you're going to probably change banks. Now you can keep your current bank, lots of people do, and they bring funds over from their electronic bank is what I'll call it, which is, it's a federally insured bank. It's just like all of the banks you know, it's just that they have an online presence that's really strong. And the lender that does this loan has chosen 3 banks in nationally speaking, of which names you probably haven't heard. They're not the big banks that they use to do this. They have an online bank account, federally insured, as I said, just like regular banks. You have a debit card, you have checks, you have all of the capacities, capabilities of any other bank account that you typically would have. But it's online. And it's coupled to the line of credit directly. So when you put a deposit into the account that day, that deposit is going to be swept over. That's why this is called a sweeper loan, swept over to the line of credit the day the deposit is made. And any withdrawals that you pull out of the bank account are going to sweep back from the line of credit, off the line of credit into the bank account to take care of the withdrawals. And the net sum of your deposits and your withdrawals for that day are going to impact the balance of the line of credit. And what's really cool about this particular loan is that we do the calculation first and drop the balance on the line of credit potentially, as long as there's more deposits than withdrawals, and then calculate interest for that daily interest calculation that day. And that is means that you're basically paying principal first, is what I call it, and then calculate interest second on that. It's the only loan I know that does something with that. So we're going to show you that graphically in just a minute here. So this is a graph that's going to show you the impact of your deposit activity over time. I want to be really clear that the all-in-one loan is not for everybody. It works very well for people that have significant positive cash flow rolling through their bank. It's very much tied to your cash flow. You'll see that you can pay off your all-in-one loan very, very quickly over time. If you have positive cash flow. If you're not, if you kind of live paycheck to paycheck, which some people do, this is not the loan for you. It's a variable rate for one. And if you're not paying it down over time, it's not something you would want. But let's look what happens here if you have someone that does have significant positive cash flow and the impact to the loan. So this graph, the x-axis, the axis that's going up and down there, shows that we have a $700,000 potential HELOC with the all-in-one loan. So right in the middle of that is $350,000. And this is a month that we're going to take a look at of activity. So that y-axis down on the bottom there that goes from left to right, it shows 5 days up to 30 days in that month. And let us say that you got your line of credit and you drew out $350,000 on the line of credit, which means that you owe $350,000. You still potentially have another $350,000 remaining that you could draw on because it's a line of credit. You could draw up to $700,000 if you chose to do so. But you didn't make any activity in the bank account for the first 5 days of the month. So for the first 5 days, you owe $350,000. What the line of credit does is it calculates the interest on a daily basis, and it stores that up, and it's going to assess interest to the loan later on after the month is over in the next month. So if the first 5 days, and calculate interest, whatever your rate is, and remember that's your index plus your margin on this loan, to the loan, it's interest only payments. That's how it calculates. And that would be the interest expense each day for the first 5 days. But notice in day 5 that it drops there. That's because you had some deposit that came in. It could be your paycheck, could be rental income from rental properties, could be your IRS check, could be your Social Security, could be any kind of a deposit activity that you put into your account, and it drops the balance of the line of credit by the amount of the deposit on day 5. And it calculates interest on that lower balance. But let's say you got to live through the day time. So for the next 5 days, you have withdrawals that are coming out of your account. You're maybe using your debit card, maybe you're going out to dinner and you're using it for that. Maybe you're writing a check for some purpose. Whatever the case may be, you're going to the ATM and pulling cash out, whatever it is. As you pull funds out of your bank account, what happens on the day that you do that is the balance of the line of credit, the all-in-one loan, increases on a daily basis. So at the end of 10 days, it's increased back a little bit, close to where it was at, but not quite, because you have more deposits than you have withdrawals over that time period. And then day 10, you put another deposit in there and you see that it goes down. And then days 10 through 15, you're living, and so you pull funds out of your bank account. That impacts the line of credit that day. So the balance goes up. Day 15, you make a deposit, it goes down, and you can see the activity here. So notice that there is a downward trend happening with all of those deposits. So the balance on your line of credit throughout the month is having less interest expense every single day, potentially, as long as you have more deposits going into the account than withdrawals coming out. Okay? Marion, do you see any questions right now in the chat box about this while at this particular point? And you're muted. I can't hear you right now.
Not quite. No
Okay, very
questions
good.
yet.
All right, we'll continue on, guys. So that's the activity on a day-to-day, monthly basis. All right. And once again, positive cash flow causes the interest expense to be lower every single day. So let's take a look at what that does over time on this line of credit. So this graph represents the funds that are available on the all-in-one over a period of time. So you have the same $700,000 availability of funds on this line of credit. And notice it's at the 10-year mark there that it starts, there's a line drawn all the way down to 30 years. It starts going down. That's the available funds that are available on the all-in-one loan. So for the first 10 years of the loan, you have the maximum amount that ever you drew on and what you have available, in this case, 700,000 available to you. But on the end of year 10, there are 240 months left, 20 years left. On each month, the available balance that you can draw on decreases by 1/240th. So it's a straight line from year 10 down to year 30. As long as you keep your balance below that black line, then you have available funds available that you can pull from on the all-in-one loan. A very significant difference between it and a regular line of credit. So if you are that person that makes payments throughout the month and you have positive cash flow, what happens on this loan is that it gets paid off very, very quickly. It really starts exponentially kind of kicking into gear because the start of month 2, it starts with lower balance than month 1. You have the same activity that we talked about earlier. It pays it off even a little faster. And you have that curve, which represents there on the graph there, that you could pay off your $350,000 balance in less than 10 years. I have clients that there's a test of this, by the way, that you can do with a simulator that we're going to provide to you because we want to make sure the loan works for you just as well as you want to make sure the loan works for you. And you can put in your cash flow and what the rates are and what your expenses are and all of that, and it will tell you, it'll forecast how quickly you're going to be able to pay off your loan over time. And I have some clients that are taking loans and paying them off in 5 to 10 years, much quicker than their 15-year fixed or a 30-year fixed, and still potentially have that available line of credit for purposes that you may need. And there's 2 purposes I submit. One is for opportunities. So real estate investors love this loan because what happens is maybe you find a house that you want to buy and you need a down payment. So this graph shows maybe on year 5-ish, you pull some funds out of your line of credit. So the balance that you owe goes up. That's what that little T represents there. Goes up to maybe $400,000 or so. And then you continue the same positive cash flow activity, and that would get paid off over time like that. It might stretch it out to 12 or 15 years or whatever it is. The point is, 2 points here, guys. The second purpose, by the way, you can use the line of credit for is for emergencies. So this, you stay below the black line, opportunity comes along, you want to buy a home, you want to purchase whatever, you want to go on a vacation, you can use your line of credit for that and then pay it off with your regular cash flow with no change in your budget, as long as you have positive cash flow compared to your deposits and withdrawals coming out of your bank account. Saves you thousands of dollars of interest expense over time. That's the magic of the way the loan program works. So I want to switch gears here. We're going to talk about guidelines. Marion, feel free to interrupt me if there's any questions that pop into the chat box, and we can chat about them as we go. So once again, this top graph here shows how much you can pull out with your primary and secondary properties and your investment. Notice on the primary and secondary, I don't know if you can see my mouse here or not, probably not. You can draw up to $1 million at 80% loan to value on your home, or up to 1.5 million to 75% loan to value, or up to $2 million on a line of credit, as long as you're at 70% of the value of your second home or your primary residence, and you have a 700 credit score. That max initial draw on the right-hand side there, where it says 99% of the line amount on all transactions. When you first set up your line of credit, and you can use it for a purchase, guys, or you can use it as a refinance, either one. Whenever you set it up, they're only going to give you 99% of your available balance initially. So you have that extra 1% sitting there to take care of the interest expense for the first month while you're not making a payment for it. And the way the payments are made, I should mention that here. This is a good time to do that. What the line of credit does on the all-in-one loan in particular is it calculates on a daily basis the interest expense after the net sum of the deposits and the withdrawals coming out of the bank account. And it stores up that number each day of the month for the month. And then the 21st day of the next month, it takes that interest expense, it assesses it back to the line of credit, and your line of credit will increase by the amount of the interest expense used for the prior month. That's how it works. It's automatic. You don't have to do anything at all. You don't have to make any payments. You don't have to worry about that. As long as you have available equity in your line of credit, it takes care of the payments for you. As long as you're doing positive cash flow, the payments are lower and lower and lower each month because the interest expense is lower and lower each month, and it goes down over time. Back to the guidelines, guys. As an investment property, on that same little matrix there, you can see that you can do a purchase and rate and term. Rate and term is a refinance where you don't get cash out. You can get up to $2,000 in your pocket after closing costs and be a rate and term refinance. Anything greater than $2,000 is cash out. Notice a rate and term, you can go to 75%. That's also on a purchase. Or a cash out, if you're going to do a refinance, you can go up to 70%, up to $1 million on the all-in-one loan for an investment property. Notice that the minimum credit score is 720 for an investment property, and it needs to be 700 on an owner-occupied. And just one thing there, max cash out, if you do a cash out transaction, is $250,000 on that. Couple points. On the bottom left of the screen, you'll see primary residence and second home. There are 3 options available on the all-in-one loan. You can do a monthly adjustable, so it starts out on the first month, second month, the rate can change depending on the index, the treasury bill. However, if you choose, you can get a 3-year fixed loan. So that means your rate's going to be fixed for the first 3 years. At the end of 3 years, it goes to a 1-month adjustable, and it follows that for the rest of the term, which could be 30 years on this all-in-one loan, as you'll remember from our slide. Or you can get a 5-year fix. It's fixed for 5 years, and at the end of 5 years, it goes to a 1-month adjustable from the term thereafter. Investment properties, not quite as many options. You have the monthly adjustable available, and you have a 3-year fixed rate available, and then it goes to the monthly adjustable on that. Yes, the 3 and the 5-year fix cost more upfront because you're fixing your interest rate for a longer period of time. So, and you do the simulator, and this works really well for some of my clients. Some of them have enough cash flow, they're going to pay off the loan in 5 years. But there is that variability of rates, and rates are going up right now, short-term rates in particular, which is what this is. So you may choose to get a 5-year fix because you're going to pay the loan off in 5 or 6 years, and it's very predictable then because the rate's not going to change. That's why people would use that particular product. I mentioned this to you before, that the maximum loans you can have is 2, and you can only have 1 on an investment property, so you're not going to be able to do 2 investment properties at the same time. And then you do need reserves. The reserves are tied to your debt to income ratio. So the maximum debt ratio is 43% on the all-in-one loan. If your ratio is up to a 43% maximum, we're going to require 15% reserves. That means this: whatever the amount of the line of credit that you qualify for, let's say it's 100,000 for ease of figuring here, you will need 15% of that, or $15,000 in that case, in reserve in some other account. That's some liquid account. It could be your checking, your savings, a money market account, a retirement account, anything that has liquidity to it satisfies that. Stocks satisfy that very well. If your debt ratio is less than 40%, you only need 10% of reserves. And then 10% of the line amount for your reserve. Additional reserves are required, by the way, if you have multiple properties. And that's a Fannie Mae requirement too with a regular loan. So if you have investment properties that are rentals, we're going to take the number of payments on those. We're going to calculate an interest. And it's usually, by the way, 3 months for each rental property, 3 months of payments to add additional reserves for the loan. Cruising along here. I do want to mention some special things about the all-in-one loan, and one of them is called asset depletion. What this means is if you don't have enough income from the regular income that we use to qualify you for the loan, maybe your W-2 income, if you're self-employed, your 2-year average of self-employment income. If you're an investor, we use the income off your investment properties. Let's say you don't have quite enough income there. You can use assets as a way of calculating qualifying income for a loan. And they have to be liquid assets. And you can see that here's what applies for this. We'll use checking, savings, the money markets, for CDs, stocks and bonds, mutual funds, and even your retirement accounts. If you're greater than 65 years of age, we'll take the total sum of all those assets, as long as you don't use those for closing. So if you're going to purchase a home with the all-in-one loan, and part of your assets are going to be for the down payment, and parts also, by the way, needed for reserves, we're going to back those funds out of that calculation. Anything that's left over, we'll take the total that's there and divide that by 120 months, and we'll use that as additional income to help qualify for the loan. If you're less than 65 years of age, we'll use 100% of all those accounts you see that are very liquid, except for stocks and bonds, mutual funds, and retirement accounts. We're only going to use 70% of the balances that you show. We add that together, and we do another calculation divided by 120 months, and that's the qualifying income there. Down below in those bullet points, you'll see gifts are allowed for the purchase. Borrower must have 10% of their own money in for the down payment, but the rest can be gifted to them from a family member. Gifts are not allowed for that reserve calculation. The borrower has to have their own. You can get a seller contribution up to 3%. Or it can come from the real estate agent. That's the interested party in the transaction to help cover your closing costs if you're using those for a purchase. Gift of equity is allowed on owner-occupied. So if mom and dad want to sell a home to the kids and they have 20% equity there, they could gift that 20% as the down payment to the kids, and the kids could buy the home using that 20% gift as their down payment. Eligible properties are single-family residences, 2 to 4 units, so 1 unit up to 4 unit works. Condos, the maximum acreage notice is only 5 acres with the all-in-one loan. That is a restriction that it does have. But we won't do manufactured homes, no condotels for my Hawaii clients, no co-ops, no leaseholds, no unique homes, which is like log homes and geotech homes and things of that nature, and no rural properties as defined by the appraiser. So when we get the appraisal in, the appraiser is going to tell us whether it's urban, suburban, or rural. If they call it rural, then the all-in-one loan is not the loan for you. Note down below there, the last one that's really important to know: free and clear properties are not eligible for this unless they will do an exception if you need funds for a near-term financial obligation. And what this usually means for my clients is they want to buy a rental property, so they do the all-in-one loan on their residence, which is free and clear. They use portion of the all-in-one for the down payment on the rental home, and that's obvious that they're going to do that. Then the underwriter will typically allow that. But if it's just a free and clear property and you don't have any reason for the funds other than you want to set up a line of credit, then this line of credit is not the right one. We'll do another line of credit for you for that. Okay. So you probably know by now that the best people for the loan are people who have significant positive cash flow. And the simulator I mentioned to you, I should have a slide on that for you guys. The simulator is a link that I'm going to send to you that has an online simulator that you're going to go to and create your own username and password, and you're going to put your own cash flow in and your own expenses in, and it will tell you, and it'll tell the underwriter, and it'll tell us whether this loan is a good loan for you. If it pays off the loan quickly, and it's going to give you those very graphic description on that. And you're able to save thousands or hundreds of thousands of dollars compared to a 30-year fixed, it may be the right loan for you. So borrowers that have significant positive cash flow are people who likely want to know about this loan. If you're not that borrower, this is probably not the loan for you. Real estate investors who qualify with verification of their income, remember that we're going to verify a full doc. So it's not the real estate investor that doesn't do the regular verification. It's the person who uses 2 years of tax returns and all of that. But it's a great loan, especially if you're comparing it to purchase multifamily, like duplexes up to fourplexes, because the pricing of the all-in-one loan can be really significantly better. And I know this from personal experience with my clients than at Freddie Mac or a regular conventional Fannie Mae kind of loan. So some real estate investors love the loan. And then, of course, financial advisors that we work with and financial coaches, they love to show this loan to the right kind of client as well, because it can really help with their financial planning, because you free up equity and you can use that equity for multiple purposes, depending on what your planning needs are there. That is the all-in-one loan. Marion, any questions from anybody? And you're muted, Marion. I'm not sure Marion's there. Let me see if I can see the chat box myself. Oh, there you are. Any questions in the chat box, Marion?
I don't see any questions, John.
Well, either I've been really, really, really good or not so good. We'll move forward, guys. I do want to let you know the webinar schedule for the rest of 2020. Well, not the rest, up through May here. Today we did the all-in-one loan. Next 2 weeks from now, we're going to be talking to John McEwen, who has McEwen Financial. That's what that should say. He's going to talk about wealth building strategies and with non-stock investments. John is very compliance oriented. I'm not supposed to say non-stock investments. I want to clear that up right now. He's going to talk about wealth building, and he's going to tell you the products that he uses there. After that, 2 weeks later, we're going to talk about mortgage insurance strategies. Mortgage insurance is a great tool, especially if you know there are multiple options on how to use it. So one of the reps from MGIC we know is going to chat with us. May 17th, you can see 1031 exchanges. We're going to have an actual facilitator from what I think is the largest 1031 facilitating group in the United States chat with us about 1031s. May 31st, another financial coach who has some really innovative approaches to building wealth. And there are more to come after that. I do want you to know that we have done these previous ones here. If you have any desire to get a recording on the webinars we've done already, and you can see them there, tips from a real estate investor for self-employed borrowers. We talked about Puget Sound real estate market. It was a great conversation with Angelique, from the REAPS organization, and the others that you see on the screen right there. Just let us know. We're happy to send you links to those and you can check them out. There's my contact information, guys. Reach out to me with an email, reach out with a phone number, reach out with a text, either one. I'd be happy to chat with you. Answer any questions you might have about the all-in-one loan or all other kinds of loans we do at Bay Equity. We do conventional, jumbo, government, USDA, FHA, VA, all those kinds of loans. So let us know if you have any questions. Happy to talk to you about that. Marion, last chat with you here. Are there any other questions that any of the webinar participants might have that I can address before we end this little guy?
No, not that I see, John. Thank you.
Okay. Thank you. Thanks you guys for participating on the webinar. I appreciate it so much. We'll catch you next time around.